If they wanted to teach you, they would, but they won't, so I will. Only 6% of people in Britain have a stocks and shares ISA, which means that 94% of people in the UK aren't investing in the stock market tax-free. One of the main reasons for that is because they don't understand anything about stocks and shares and investing. It was actually one of the main reasons it took me so long to start investing in the stock market, but since I started to learn, I've ended up making thousands. But the first stage in understanding how money is made is understanding the language used to make money. These are the top 5 terms you should know when it comes to investing. Firstly, stocks and shares seems like a good place to start. When a company wants to raise funds, they can sell part of their company to other people. In this case, you. The company's divided into many small packages called shares that you can buy. It's called a share because you're literally buying a share of the company. Stocks is the term you use to describe a collection of shares from wherever you've bought them from. Secondly, dividends. Dividends are easy. This is the amount of profit that a company makes that it shares with its shareholders. I.e., if you hold dividend shares, it is possible for companies to pay you a share of the profits because you technically own part of the company. In fact, a lot of people make really good passive income from dividend shares. Thirdly, index funds. Index funds are an allocation of hundreds or sometimes thousands of companies that you can invest in all at once. Because it involves the value of so many companies, they usually are only valued once a day and you can only buy or sell them once a day, which is not ideal for the common investor like you and me, which is why the most common way to invest in index funds is through ETFs. Which brings me to term number 4, ETFs. ETFs, which stands for exchange traded funds, are a way for people to invest in index funds with a lot more flexibility. You see, ETFs follow index funds, i.e. if the index fund that the ETF is tracking goes up, then so does the ETF and vice versa. The main differences between index funds and ETFs is that ETFs can be traded throughout the day and usually allow smaller investments, making it a better option for the common man or woman. Fifth on my list, we have diversification. This is the financial way of saying don't put all of your eggs in one basket. It is the practice of investing in several different types of asset classes or stocks to spread your risk, i.e. buying shares in a few different industries so that if one industry is not doing so great and crashes, which happens from time to time, another industry you're invested in can make the loss a little less extreme. Diversification is a key way in spreading that risk, and investing in an ETF is a great way to do that when it comes to investing in the stock market. Let me know in the comments how many of these terms you already knew before you started this video, and follow me for more content on finance, careers, and current affairs.